going on, everyone? Welcome to the channel, the DIY Investing Guy. I'm just bringing to you my second episode of my Freetrade portfolio. It's been a couple of weeks since the last one. I'm meant to do more frequent portfolio updates, but I've just been quite busy the last few weeks. Also, I've slightly changed the way I'll be investing in these in my Freetrade accounts. I have opened an ISA. I've decided to open my stocks and shares ISA with Freetrade this year, so I've had to move a few of my holdings over to my ISA account, and I've kept my general account separate now. And I'll be going through what I'm using the general account for in a moment. And I'm going to just be going through each individual company inside my new portfolios and how I'm going to invest for the next year. So if you like portfolio updates and you enjoy stock market and investing in the stock market, please subscribe to the channel. Hit the like button for this video to get this content out there and share with everybody. And if you could hit the notification bell for future videos, that would help massively to help the channel grow. First of all, I'm just going to be going through my portfolios in this video. I'm going to try and go through it as quickly as possible. They're not big portfolios at the moment. I've only just started them in the last month. I've done a previous episode on the brief outline of how I'm going to be investing in the Freetrade account for the next year. The episode one's on the channel, so if you want to check that out, episode one's on the channel already. First of all, I'll just go through my general account quickly. I've got £820 in this account. It's a bit more than I'd want to, but originally I was just going to have the general account and have my stocks and shares also with Hargreaves Lansdowne, which I've just decided to open a stocks and shares also with Freetrade this year, just so I can sort of average into my companies without the commission charge. So I'm going to use this account for my Chinese companies. So obviously Chinese are a bit more risky due to de-risk being taken off the US market. So just look, there's risks with the Chinese market that aren't associated with UK and US equities. But I think Chinese equities at the moment are vastly undervalued. Like some of these companies that if they were US companies, they would be double the price they are now. The likes of Alibaba and the likes of Huawei. And then I'll just show you a few on my watch list. I am contemplating an investment into JD.com, which is a Chinese e-commerce site, very similar to Amazon. And it's had quite a bit of a sell-off. All Chinese companies at the moment have had a sell-off. Here's some other companies on my watch list. Baidu's quite a good one. That's a Chinese Google. Tencent Music, Coupang's Korean, but this isn't just Chinese. It's all Asian equities that I'm keeping in this account, as they're a bit riskier. So there's my watch list for Chinese companies. So I'll just go through the companies quickly that I've got. I've got Huawei, which is a game streaming site. So if you're playing your games, you stream. It's very much like Twitch, but it's the biggest one in China, and it's massively undervalued at the moment. I think it's currently at $16 a share. If it was a US company, it would be about $40 a share at the moment. As you can see, the 1 month graph, it started off at 17, went back up to about 18 a share, and it's just massively sold off in the last week. But a lot of stocks have sold off in the last week. Chinese stocks have been hit the biggest. Well, growth stocks and Chinese stocks. As you can see over the year, it's got highs of 25, then highs of 30 there, which was only in mid-February, $34, and it's just halved, lost 50% of its value in the last couple of months. It was rumoured to have a merger with another video game streaming company in China, which is called Douyu, but that was blocked by the Chinese government, so that's had a bit of a hit to the share price. I think a lot of investors were waiting for that to be okayed, and then they were going to pile into the stock, but that's not happened. But I still think it's it's still a $40 a stock, $40 a share stock, and I think eventually that it will realise its true value. So yeah, I've brought into this company. I've got 37 shares in this company at an average price of £12.89 a share, which is converted from dollars. I have got a conversion to work out the conversion, but I think it's roughly about $17 a share. And I'm currently sitting on a £42 loss, 8% loss. But I will be adding more into this every month. What while the stock price is under $20, I'll be adding, you know, between $50 and $100, £100 a month into this stock. And the same with Alibaba. I spoke about this a lot in the last video, and obviously if you've seen my Hargraves Lansdowne account as well, it's quite a big position in my main portfolio. I think it makes up about 87% of my portfolio at the moment as a whole, and it's currently at $225 a share. Obviously, I had news of it paying it's fine, but I still think, you know, if this was a US company, it's very similar to Amazon. It's growing at a massive rate for the company of its size. I think it would be trading at about $400 a share if it was a US company. It's also Charlie Munger, who's famed investor, doesn't make very many investments, as he has made a large investment into this, that about 37 million through the Daily Journal at around about these prices. So, and patience is the key with this one. I think it will realise its true value soon and grow a bit more. So it's just one to hold for the long term. I think it's undervalued. You know, it's anywhere between $300 and $400 a share would be a good price for this at the moment, where it should be at. So it's just waiting to see how long. And also, I'm going to be, you know, while the prices are still in the low 200s, I'll be adding 100 to 50 pounds to £100 to this holding every month. I've got 2.3 shares in this at an average price of £169 a share. I've got that down from the last video. It was around about £175 a share, but I've averaged down into this stock. I'm only sitting on a loss of £17.82. And so while the stock keeps on going down, I'll be adding more to it as time goes on, and hopefully building a decent position in this. I don't want the stock price to fly up to $300, $400 a share at the moment, because it will stop me being able to build a position in this. I'm not going, you know, I'd like £1,000 position in this portfolio eventually. So if I can build a position over the course of 2021, that'd be great. Same with you, yeah. I'm only adding between £100, £50 and £100 a month to this portfolio at the moment, because Chinese stocks are, you know, as much as I like them, I think they're undervalued. I don't want them to be too much of a big portion of my overall portfolio. So yeah, that's all I'll be adding, and hopefully getting a decent averages on these companies, and hopefully in the long term it will pay benefits. And then let's just go to the main portfolio now. Is my ISA, and I'm down £24.93. I only opened it a couple of weeks ago. I've only really added my money payday, I think it was Thursday. So yeah, and most of these losses have been in the last few days, you know, because there's a big sell-off in the growth stock market and stuff. Now with these, I am investing in this portfolio for growth. These are my holdings in it, and yeah, so, but I'm trying to get them at decent fair valuations. So I've brought into these stocks, and I'm really concentrating on just these 5 stocks, because there's so many stocks out there. There's the likes of Peloton, Teladoc, all sorts of stocks that have just had massive sell-offs, and everyone's talking about them lately. But you know, I've only got so much cash, and I've got to manage my cash pile and cash positions. So if I start buying little bits of everything, I'll be spreading it too thin, really. So I'm going to concentrate on these 5 companies that I like, and I think I've got long-term potential. I do like to invest in companies that have got a brand. So yeah, there might be a technology company, there might be a food company, but if I think they've got a good brand, that's what I'll invest in. So it's not just necessarily a growth of value. I think that the companies have got to have a good brand. So I think these are 5 good future brands that I've invested in this portfolio. My largest position is Tahu Chef. I think this is a great company. It makes plant-based foods. It's not just meat substitutes like Beyond Meat. It makes you know, cauliflower pizza crust. It's famous for, and it's increasing its SKUs. So it's going to have a lot more lines over the course of 2021. Its sell-through rate in Target and Walmart's amazing. It's constantly up in its guidance. It's just had a great earnings this week, but the stock's still just not really done anything. Well, it hasn't had good earnings this week, but it's increased its guidance on its earnings. It's constantly having good earnings. Its balance sheet's decent. It's on the verge of quite decent profitability. And it's just announced that it's made the acquisition. It's got great cash. It's got a lot of cash, but it's made an acquisition of for 35 million for these Mexican sites to manufacture. And it's already an existing company, but it's brought these sites that are already ready to go and manufacture at scale foods, and obviously it will take it down through its Mexican lines and stuff as well, which it can improve on. So that's a good sign, and it's got it for quite a good price, I think, because I think it would, if they were to build these facilities itself and start manufacturing, it would have cost a lot more than 35 million. And I think they've, part of that is to do with they want to, they need the capacity to be able to fulfill orders to these bigger stores, and it's also got Kroger and stuff like that. Hopefully in 2021, which is the biggest retailer in America, it sells through Costco as well. So yeah, and the products seem pretty quality at the moment, and I think plant-based products isn't just a trend. I think it's a long-term trend. It's not just a fad. And it's my biggest holding in all my portfolios at the moment, and I'm very bullish on this company. I just think it's a great company. It's a great brand, great products, and it's well run. It did have a short seller report a few weeks ago, but it was there wasn't nothing to say in the short seller report why it was shorting the stock, really. No good reasoning behind it. But I've got in this portfolio, I've got 32 shares of this, an average price of $12.42, and anything under $20, which I think my average price, if you convert, is about low $17. Anything below $20 in this stock, I think you've got a great margin of safety. I think it's currently valued at about $40 a share, so I'm going to keep on buying this stock every month, between 100 and 200 pounds into this stock every month, as long as it stays below $20. I've already got a decent sized position in it. I think it makes up about 12% of my overall portfolio at the moment, so I'm happy with that. But if the prices stay like this, I'm just going to load up the truck and build quite a decent position, because I think in the next 5 to 10 years it's going to be a decent multi-bagger for me, in my personal opinion. So yeah, that's my position in Tahu Chef. As you can see, I've just brought in over time, and I'm going to be buying more of this company, hopefully, over the course of 2021. And then I'll just sit on it. Obviously, everyone knows what Tesla is. I just view this as a good brand, and I'm starting to see more Teslas on the street. My margin of safety price is anything below $700, and obviously, as you know, I had it on my previous portfolio, and I've just moved it over to here, and I've added $50 because there's been a dip in it. I sold it in my portfolio at about $7.33 a share, so I've brought back in at about $6.80 a share, so I haven't done too badly there, yeah, but it's down at the moment, but it could go down to $600, and I'll buy even more. My main aim in this portfolio is to get one share. I already own one share in my main portfolio, and I just want to get another share, and hopefully just sit on it for 3 to 5 years and see how it goes. I think it will increase in value over time. It is quite a highly valued growth stock, but I see it more as a brand than a technology company. I know it's got autonomous driving and taxis and vehicles and all sorts of stuff like that, but at the moment I just see it as a strong brand. Even with the main manufacturers making electric cars, I just think Tesla's well ahead of them in terms of technology, and the brand's quite strong. I think it's like an Apple. People want an Apple Watch, people want a Tesla car. So if Tesla's become more affordable, it'd be more fashionable to drive a Tesla, and I think people will enjoy that. So that's how I'm viewing Tesla. It actually made, in its last earnings update, it didn't have a bad earnings update. A lot of these companies have had good earnings updates, and the stock prices have tanked. And I think that's just a rotation out of growth to value. It actually made quite a decent profit off its Bitcoin investment, to be fair, which is it's insane. It's made more money off its Bitcoin than it has its actual selling of vehicles and its main core business. I've brought into Skills, which is a online e-gaming platform where gaming developers put their games on, and people play their games, and they pay to. It's basically they pay to compete. The money goes in the pot, and then the winner takes the money out of the pot. And it's quite a simple way to how they make their money. Skills is they take a percentage of the entry fee, and it's just simple. You know how they're making money. Obviously, it's unprofitable at the moment, but that's due to a lot to invest heavily in marketing and research, marketing, which I'd rather it do because I want it to scale its business, and you know, it could be profitable. It's looking at about a 25% margin, but I'd rather it be profitable on 3 billion in 10 years or 2 billion in 5 years than 230 million revenue at current. So I'd rather it scale its business and then become profitable as the revenues are increased and as the brand awareness is further out there. It's a very sticky platform, like Warren Buffett calls Apple and iPhones and stuff, very sticky products. Once it gets its customers on there, it retains them. And there's a lot of research out there to show that the people that are on skills spend 60 minutes a day, whereas that's more than they'll spend on TikTok, YouTube, Facebook. It's a very sticky platform that people like to be on. It has been short in recent weeks. First of all, it was short that its revenues and its growth wasn't going to be as good, which, you know, and that you'd see it in the earnings, which they brought out guidance for the earnings earlier saying that wasn't the case, and then the actual earnings were even better that were this week. The price has still gone down. It's just another case of great earnings where the prices are going down, and now they're focusing on how much they're spending on marketing and stuff, which I think is ridiculous, the short sellers, because as a small cap company that's needs to increase its, you know, getting customers onto the platform, it needs to be spending on marketing, and then it said, well, it hasn't got very many people coming onto the platform. It's only a small increase, but the actual increase of paying customers is the most important thing, because that's how they make money, is by having paying customers. So the short sellers are just focusing on anything they can to get the stock down, which is a good, if you believe in the company, it's a good time to be getting in the stock. I'll just be careful with this one because it is very volatile. I mean, it was $21 a week ago, and I was up about 20%, 20% on it, and now it's back down to 15. I have, in my main portfolio, I've put more than I'd like to in it because I think the price is good, but I didn't go fully into it, because if it goes back down to $12 like it did a couple of weeks ago, I'll put more into it, and then I'll obviously trim my position when it gets to about $18, $20. But you've just got to work on the volatility at the moment. Don't be going thinking you've missed the boat and it's at $20 and just buy it, because you could lose a lot of money in a short space of time. So you've just got to work on the volatility. As you can see from the chart, the last month, it started the month at 17.28, went all the way down to 12.55, and then it jumped all the way back up to $21, and that's just slowly gone back down. So I'd say anywhere between, you know, this line here of $17, $18, don't be buying anything under, anything below in the $16 range. You can buy and add and, you know, average down. But then once you get past this $17, $18, you just need to let it go up, maybe trim your position, and then buy back in when it dips a bit further again. But ideally, I'd like to keep this at about 5% of my portfolio, because it is a non-profitable company, but I do believe in it over the next 5 to 10 years, especially as it, once it starts cutting back on its marketing and spending, once it's got more brand awareness, it will be more profitable. So yeah, let's just have a look at my average buying of these. Yeah, I've got eight shares in this. I've got a bigger position in my main portfolio, at roughly about £11.83, which is about $16 a share, which is a great average. I'd like it to be about $15 a share. I think that, you know, the upside for this company in 5 to 10 years time at $15 a share is amazing. But yeah, so while it's under the prices I've stated, in the $16 to, you know, its lows of about $12, I'll be buying, you know, at least £100 a month into £100 a month into this company, and obviously riding out the volatility. But once it goes above that price, I'll just sit on my position and hopefully have great long term gains. Yeah, so that's basically what Skills is. So I'll come back out of this one, and then Moonpig's my UK company. Obviously, I've done a video on Moonpig. It's my only UK company in this portfolio. It's a personalised greeting cards. Everyone in the UK will know what that is, but you just order them online and it gets delivered the next day. It's a great little company, and I think it's set for long-term growth, because I think that's where consumers will be moving over to now, is especially over just the ease of buying these companies, buying these cards, and they're not too expensive. The markup's quite high. They've got good profit margins on the company, and I think it's going to be a steady performer over the next 10 years. So I'm hopefully going to build a decent sized position in this. I'd roughly like £1,000 holding in all these holdings, that I've got in this portfolio, so I won't go too much into that. I've got 22 shares. It was in my last portfolio update. I've just moved it over to my ISA, roughly about the same price, same averages. So, you know, I'm just sitting on it's pretty flat at the moment. It's not no gains, no losses on it really at the moment. And then finally Draftkings, which is a very similar company to Skills, except it's an online fantasy sports betting company, which fantasy sports basically is you build up your team, so whether it's the Premier League or the NFL in America, and you build up your team of whatever they are, and then you put them in a league and you bet against other people, in your friends on the platform, or you know, have a public league, and obviously the money goes into a pot, like your entry fee goes into a pot like it would with Skills, and then they take a percentage of that, and the profit margins can be quite high. I don't think they're as high as Skills profit margins. I think that's 95% for Skills, but they are quite high. And obviously the stocks took a bit of a battering over the last couple of weeks, and mainly this week it's lost about 10-12% of its value. And I think £50 is $50 is a decent price target for this, based on future growth. And when it becomes profitable, £50, you know, $50 is a good price target for this, and it's just gone below that now. I brought it higher in this, but in my main portfolio I brought some of this at $50 yesterday. It went down a bit more, and then the earnings last night come out, and they were beating expectations, and they'd already upped guidance, and they've upped guidance again. Now this might take about 5-6 years to become profitable, this company, but once it does become profitable, and once it's scaled up to that where it needs to scale up to, I think it's going to be a very profitable company. It's going to be a very good growth company. And even on a multiple of 20 to 30, these prices now, you're going to double your money every 5 years. So obviously that's my opinion. It's not a recommendation to buy or sell this company, but that's what I think. So now might be a buying opportunity. Once again, it's another company that's had earnings this week and it's gone down. But I think, from what I've seen in earnings weeks and earnings seasons, the stocks that have good earnings often do go down. It's like buy the news, buy the rumour, sell the news sort of thing. So people might just be trimming profits and rotating out into value stocks and whatnot. But obviously I've got a 30-40 year time horizon on my investments, so I'm looking for growth. And that's his 1 month chart. As you can see, the trend in a lot of these companies have gone down, and it's given me a buying opportunity because a lot of them were priced before where I didn't really want to start a position in them. So I've lost the most in this because I think I brought this about £41 a share, which is roughly about $56 a share, and now it's at $48 a share. So I've lost 15% just on this £100. I haven't lost that much in my main portfolio because I've brought a cheaper price and averaged down. So I might be adding doubling down this position and making it a £200 position this week. So adding another £100, and then obviously getting my average down, because I've only got 2 shares in it, so maybe buying another 3 shares and getting that average down. It's only $15 loss because obviously I'm averaging into these positions. Yeah, so it's also, with the states opening up and legalising sports betting in America and betting in more states in America, and it's got, I think it's the largest in America. It's got 80% market value. So even if it loses value over time, as the market increases, so will it's even if it has a small, it's still going to have a larger revenue stream coming in. So yeah, I think it's also going into iGaming as it's been legalised. It's iGaming is basically traditional sports betting. Like a lot of UK people will know what that is, and it's quite popular in the UK, where you're betting on other sports teams and how they do, goals, wins, losses, stuff like that, and an online casino. So you've got your poker and just stuff that you'd have in casino but online. I think it's going to be very popular in the States. So yeah, that's my final holding in this portfolio. I've got a few on the watch list, few blue chips like Coca-Cola, Apple, Lam Research does semiconductors, Beyond Meat. I do hold that in my main portfolio. But yeah, the price is just tanked in Beyond Meat, but that had poor earnings. So if the price is tanking with good earnings, it's going to tank even worse with poor earnings, isn't it? Greggs, Boohoo, JD. I've done quite well with these stocks this year, but I think I'm priced. Boohoo's looking quite attractive now. If it gets below the £3 mark, that might be added to my main portfolio. Galloway Golf, which is a great company, but that's had a good run recently. Obviously, what I'll say is I've sold out of Deliveroo this month because there's just so many opportunities, and Deliveroo was more speculative than anything. It might never become profitable. It might go bankrupt. You don't know with Deliveroo, and it was more of a speculative buy than anything. So I've just got rid of Deliveroo, and I didn't really lose any money on it, and I've just invested in other companies. The other company I'm looking at in the UK as a good investment, maybe adding this to my ISA portfolio, is Naked Wines. Now, this is a great company, and I wish I'd have invested a few years ago when it was Majestic Wines, and it was such a cheap company then. £3 a share, it went down to about £2 a share, and I would have, in the space of 18 months, I'd have 4 times my money. But as with Card Factory, I missed out there. I didn't see the potential upside. I only looked at the downside, which the downside was I could have lost a couple of thousand, but the upside is I could have made £6,000, £7,000, £8,000 on the stocks. So I'm trying to look more at the upside now. I've got a long time horizon. As long as these companies aren't close to bankruptcy, which they're not, because a lot of them are cash rich and they can raise more capital as time goes on, I'm happy with what I'm holding, and I'm not really looking for the short term. It helps that, I go to work, I have other hobbies besides investing in the stock market, so it keeps my mind occupied, and I try not to look at my portfolio every day, and I try not to look at it every hour or so. I try to keep my mind occupied, and I'll just be investing, constantly saving and investing every month over the course of 2021 anyway, and I'll try and keep you all updated on a regular basis. I hope you've enjoyed this portfolio update. I've probably spoke a bit longer than I'd like to today. So if you've enjoyed it, can you just smash that like button to help the YouTube algorithm get the video out there. If you're new to the channel, please subscribe and hit the notification bell. Until my next update, have a nice day, have a nice week, and hopefully the stocks I've invested in my next update will be showing a bit more green than they are now. Thanks, guys.